It is officially over. The waiting is done. The speculation phase has ended. The moment that every silver investor, every stacker, every person who believed in the fundamental case for monetary metals has been anticipating for years has arrived. Ladies and gentlemen, Asian guy here from Drucker Investors. Silver has surged above $80 per ounce. Not on a flash spike, not on a temporary squeeze, on sustained, broad-based buying that reflects a fundamental shift in how the market values this metal. And I'm about to reveal to you the big announcement, the institutional upgrade, the policy shift that proves this is not the top. This is the beginning. The mainstream media is calling it a rally. They are saying silver is up 180% in 12 months. They are showing you charts and telling you that the move from $28 to $81 is impressive. But what they are not telling you is why. They are not explaining the mechanics behind the surge. They are not revealing the institutional positioning. They are not connecting the dots between the supply deficit, the industrial demand explosion, the monetary policy pivot, and the geopolitical resource war that is playing out in real time. I am going to do all of that today. And by the end of this video, you will understand not just why silver is at 80, but why 80 is not the destination. It is a waypoint on a much longer journey. I know the critics are going to say, Asian guy, you have been bullish for months. You said silver was going up at 60, you said it at 70, now it is at 80, and you're still saying the same thing. When are you going to admit that the rally is overdone? To those critics, I say this. Go pull up a chart of silver from January 1st, 2025, to today, January 9th, 2026. On January 1st last year, silver opened at $28.92 per ounce. On January 6th this year, it hit $81.27. That is a gain of $52.35. That is 180% in 1 year. For context, the S&P 500 gained 23% in 2025. Bitcoin gained 120%. Silver beat both. It was the best performing major asset class of the year. And the fundamentals that drove that performance have not weakened. They have strengthened. So when I say the rally is not over, I am not being stubborn. I am reading the data. And the data is screaming that we are in the early innings of a structural repricing event. The big announcement that has institutional investors scrambling to revise their forecasts came this week from Morgan Stanley. On January 6, 2026, Morgan Stanley released a research note upgrading their long-term outlook on gold to $4,800 per ounce by the fourth quarter of this year. $4,800. That is $1,000 above the current price. That is a 25% gain from here. And why does a gold upgrade matter for silver? Because silver moves with gold. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been compressing. 6 months ago, the ratio was 90 to 1. Today, it is 50 to 1. That compression tells you that silver is outperforming gold, and when institutions upgrade gold, they implicitly validate silver. If gold is going to 4,800 because of lower interest rates, central bank buying, and safe haven demand, then silver benefits from all of those factors, plus industrial demand. Morgan Stanley cited a powerful mix of forces. Lower interest rates, possible changes at the Federal Reserve, steady central bank buying, and ongoing demand for safe haven assets. Together, they create a backdrop that is increasingly supportive for precious metals. Let me translate that from banker speak into plain English. Lower interest rates mean the opportunity cost of holding non-yielding assets like silver goes down. If you can earn 5% in a savings account, silver looks less attractive. But if rates drop to 3% or 2%, suddenly holding a hard asset that is rising in price makes a lot more sense. Changes at the Federal Reserve refers to the growing speculation that Jerome Powell's term as chairman may not be renewed. If a new chair comes in with a more dovish stance, more willing to print money to support the economy, that is rocket fuel for hard assets. Steady central bank buying means that governments around the world, especially in Asia, are diversifying out of dollars and into gold and silver. And safe haven demand means that investors are terrified. They are terrified of inflation. They are terrified of geopolitical instability. They are terrified of currency debasement. And when people are terrified, they buy tangible assets. But Morgan Stanley is not alone. HSBC, one of the largest banks in the world, raised their silver forecast to $68.25 per ounce. That is a 53% increase from their prior estimate. 53%. You do not revise a forecast by 53% unless the fundamentals have changed dramatically, and they have. Bank of America, in their 2026 outlook, said that gold deserves a core portfolio role, not just as insurance, but as a return driver. They are telling institutional clients, pension funds, sovereign wealth funds, family offices, to allocate meaningful capital to precious metals. And when the big money moves, the price moves with it. We are not talking about retail investors buying 10 ounces here and there. We are talking about billion-dollar allocations, and those allocations are just beginning. The Reuters poll of 39 analysts and traders conducted in October projected that silver would average $50 per ounce in 2026. $50? The average. We are already at 81. That means the consensus estimate is $31 below the current price. Either the price is going to crash back to 50, or the estimates are going to be revised upward dramatically. Based on the upgrades we are already seeing from Morgan Stanley, HSBC, and Bank of America, I am betting on the latter. Analysts are going to spend the next 3 months scrambling to raise their targets to 100, to 120, to 150. Because the market is moving faster than their models can keep up. Let me show you the smoking gun evidence that proves this rally is driven by real structural factors and not speculation. First, the supply deficit. According to multiple commodity analysts, including those at Monetary Metals, the silver market has consistently seen demand exceed supply. We are not talking about a one-year anomaly. We are talking about a multi-year structural deficit. The Silver Institute projects shortfalls ranging from 95 million to 215 million ounces annually. You cannot run deficits forever. Eventually, the above-ground inventory depletes. And when inventory depletes, the price must rise to ration demand. That is economics 101. The fact that silver rallied 180% in a year while still being in deficit tells you that the market is finally waking up to the reality of scarcity. Second, industrial demand. Silver is not just a monetary metal. It is an industrial commodity. It is used in solar panels, in electric vehicles, in AI data centers, in medical devices, in electronics. The transition to green energy alone is driving unprecedented demand. Every solar panel requires silver paste to conduct electricity. As countries around the world ramp up solar installations to meet climate targets, they are consuming silver at an accelerating rate. China, the largest solar manufacturer in the world, is installing terawatts of capacity. Each terawatt requires millions of ounces of silver, and China is not exporting that silver. They are hoarding it. They implemented export restrictions in January of 2026, cutting off 70% of global refined supply. This creates a supply shock that cannot be solved by mining more ore. Even if miners doubled production, the metal has to be refined. And the refineries are in China, and China is keeping the output. Third, the monetary policy pivot. For 2 years, the Federal Reserve raised interest rates aggressively to fight inflation. Higher rates made bonds more attractive and precious metals less attractive. But the inflation fight is over. The Fed is now pivoting to cuts. Lower rates mean that the yield on treasuries and savings accounts will decline. When yield declines, the relative attractiveness of hard assets increases. Silver does not pay interest. But if treasuries only pay 3% and inflation is running at 4%, you're losing purchasing power by holding treasuries. Silver, on the other hand, preserves purchasing power and has the potential for capital appreciation. This is why institutional investors are rotating out of fixed income and into commodities. Fourth, the currency debasement. The United States national debt is $38 trillion and growing. The interest payments on that debt are $2 trillion per year. That is more than the defense budget. It is unsustainable. The only way to manage that debt without defaulting is to inflate it away. Print more dollars. Devalue the currency, make the debt smaller in real terms. But when you devalue the dollar, you boost the price of hard assets. Gold, silver, real estate, commodities, all of them go up in nominal terms because the dollar is going down. This is not a conspiracy theory. This is monetary history. Every fiat currency in history has eventually been debased to zero. The dollar will not be different. The only question is how fast it happens. And the people who own hard assets when it happens will be protected. The people who own paper assets will be wiped out. Fifth, the geopolitical resource war. China is not just buying silver for industrial use. They are weaponizing it. By restricting exports, they are creating dependency. If you want solar panels, you buy them from China. If you want batteries, you buy them from China. If you want electronics, you buy them from China. And you pay in dollars. But China does not want dollars. They want commodities, they want control. This is economic warfare, and silver is a strategic asset in that war. The West is waking up to this reality. That is why governments in the US and Europe are scrambling to secure supply chains. That is why they are spending billions on domestic manufacturing. But it takes years to build refineries and factories. In the meantime, the shortage gets worse and the price goes higher. Connect the dots. Structural deficit, industrial demand explosion, monetary policy pivot, currency debasement, geopolitical resource war. Every single one of those factors is bullish for silver, and they are all happening at the same time. This is not a normal commodity cycle. This is a perfect storm, and we are in the eye of it. Now let me explain the mechanics of why $80 is not the top. The gold to silver ratio is currently sitting at 50 to 1. Historically, the long-term average is 65 to 1, but during periods of monetary stress, the ratio compresses to 40 to 1 or even 30 to 1. If gold goes to 4,800, as Morgan Stanley predicts, and the ratio compresses to 40 to 1, silver goes to $120 per ounce. If the ratio goes to 30 to 1, silver goes to $160. These are not speculative targets. These are mathematical outcomes based on historical precedent, but there's another way to calculate fair value. Look at the purchasing power of silver. In 1980, when silver hit $50, that was equivalent to $180 in today's money adjusted for inflation. So even at $81, silver is still below its inflation-adjusted all-time high. It has room to run, and if you factor in the structural deficit, the industrial demand growth, and the monetary debasement, the case for triple-digit silver is not just plausible, it is probable. Analysts at APMEX, the largest bullion dealer in the United States, are predicting that silver could reach $100 or higher in 2026. They cite tail risk events. These are low-probability, high-impact scenarios. A COMEX default, a Chinese export ban expansion, a US dollar crisis. Any one of those events could trigger a vertical move in silver, and the probability of at least one of them happening is increasing every day. Let me address the trap that the bears are setting. They are going to say, silver is overbought. The rally is parabolic. It is due for a correction. You should sell now and buy back cheaper. Do not fall for it. Yes, silver has rallied hard, but rallies are not crashes. Just because something goes up fast does not mean it has to come down fast. In a structural bull market, pullbacks are shallow and brief. If silver drops from 81 to 75, that is not a reversal. That is a gift. That is your opportunity to add exposure. The banks know this. That is why they are trying to create fear. They are publishing bearish research notes. They are raising margin requirements. They are using every tool in their arsenal to shake out weak hands before the next leg higher. Do not give them the satisfaction. If you own physical silver, the number on your screen is irrelevant. Your ounce is still an ounce. The value is in the metal, not the paper price. And the metal is getting scarcer every day. Second, watch the premium. The difference between the spot price and the retail price is widening. Dealers are charging $3 to $5 over spot for standard products. In some cases, the premium is as high as $10. That tells you that physical demand is overwhelming supply. The paper price might say 81, but if you cannot buy an ounce for less than 90, then 90 is the real price. The COMEX price is fiction. The dealer price is reality. Here's the battle plan. First, if you own physical silver, do nothing. Hold. Do not trade. Do not try to time the market. You're not competing with algorithms. You're not faster than the bots. The smart play is to sit tight and let the fundamentals work. Second, if you have cash and you want to add exposure, dollar cost average. Do not try to buy the exact bottom. Buy a little bit every week or every month. Spread your purchases out over time. That way, you get the average price without the stress of timing. Third, ignore the mainstream media. They are going to publish articles telling you the rally is over. They are going to interview bearish analysts. They are going to create fear. Do not listen. They have been wrong for a year. They are still wrong. Fourth, watch the institutional flows. If ETFs start seeing massive inflows, if pension funds start allocating to silver, if sovereign wealth funds start taking delivery, those are signals that the big money is moving. And when the big money moves, the price moves with it. Fifth, prepare for volatility. Silver is not going to go up in a straight line. There will be dips. There will be scary headlines. There will be moments where it feels like the rally is breaking. But if the fundamentals are intact, those dips are buying opportunities, not exit signals. Let me zoom out and explain what is really happening here. We are not just witnessing a silver rally. We are witnessing the unraveling of a 50-year monetary experiment. In 1971, President Nixon closed the gold window. He severed the link between the dollar and gold. He created a pure fiat currency backed by nothing but the full faith and credit of the United States government. For 50 years, that system worked because the U.S. had military dominance, economic hegemony, and the reserve currency. But that era is ending. China is rising. The BRICS nations are building alternative payment systems. Central banks are diversifying away from dollars. And the confidence in paper money is eroding. When confidence breaks, people flee to hard assets. And silver, because it is affordable, because it is liquid, because it has industrial uses, is the perfect vehicle for that flight. The people who understand this are positioning now. The people who do not understand it are going to wake up in 6 months and realize that the train has left the station. And by then, silver will be at $150, and the physical premiums will be $20, and the wait times will be 6 months. You will not be able to get in. The opportunity is now, not tomorrow, not next week, now. This is Asian Guy from Drucker Investors. Silver has surged above $80. The big announcement from Morgan Stanley, HSBC, and Bank of America confirms that institutions are upgrading their targets. The fundamentals are stronger than ever, and if you're still holding, you are on the winning side of the greatest wealth transfer in history. Do not let them shake you out. Subscribe and share this message with everyone who needs to hear the truth. The rally is just beginning.